Hello, my name is Jo Tuffle and I'm an expert tutor for the ACCA for FM. This is a Section C debrief on Nunda Stores Co. from the investment appraisal area of the syllabus.
So here is our question, Nunda Stores. Nunda Stores has 5 requirements. The first 4 are calculation requirements from the investment appraisal area. You have to calculate the net present value, the internal rate of return, the payback period, and the return on capital employed. Those are those 4 basic investment appraisal techniques that you need to know in this exam. We're going to be doing them all in the same spreadsheet so that you can use the numbers from previous calculations to work on the later calculations. This will be effective and efficient. Let's have a look at the scenario, knowing that we've got to calculate those 4 different investment appraisal calculations. Nunda Stores is a community-based supermarket. It's expanding its operations and considering setting up 10 stores in the south of its country. The directors are concerned that the payback on the investment will be long and confident the expansion will be profitable, but will show a positive return to shareholders. They normally have a target payback of 2.5 years, so we'll be using that for the payback period. And a target return on capital employed of 25%, so we'll be using that for the return on capital employed. The finance director suggested she provides net present value and internal rate of return calculations. This will enable all directors to see a full picture of the investment's potentially financial acceptability, remembering that net present value is the most superior technique. This expansion will cost $330 million, so there's your investment for your net present value calculation. As reinvestment in stores will be required every 4 years, the company evaluates on a 4-year time horizon and assumes a nil realisable value. So there's no scrap value. Working capital again is ignored because it's a cash-rich business. Now, Nunda Stores have prepared a contribution and fixed cost table for you for those 4 years. We have been given inflation on contribution at 4% and 3% on fixed costs. Those are all at current prices. We must be doing the net present value as a nominal basis. Nunda Stores pays corporation tax of 20%, 1 year in arrears. Now, I know we're doing a 4-year time horizon, but just make sure you still do 1 year in arrears for tax. The 4 years is relevant to the project, not to the cash flows. And then 25% straight line taxable allowance depreciation on the investment expenditure. That will be relatively simple because 25% is over 4 years and there's no scrap value. Nunda currently uses 10% as the nominal after-tax discount rate to appraise investments. There is your key. It says nominal after-tax discount rate. You have to therefore use inflation and tax in your net present value calculation. So we're ready to start with the net present value calculation. I've set up our pro forma for you here. We need 5 years. And we need 5 years, even though it's a 4-year project, because of tax, which is 1 year in arrears. We've got contribution. We're going to inflate the contribution. We've got fixed costs. We're going to inflate the fixed costs within the one line. And then we're going to take contribution less fixed costs to get to operating cash flows. We'll tax those operating cash flows, and then we'll look at doing the investment at time 0, with those tax benefits for that straight line tax allowable depreciation. So popping the contribution in, remember you're going to start at year 1. So 80, 160, 180, 200. We're now going to inflate that at the required 4%. So make sure you put the 4% in so the examiner knows that's what you're using. And remember, we inflate it up for the number of years. So it's going to be the 80 times by 1.04 And if you reference up the number of years, then you can literally just copy it across to the number of years. And so now if I copy that across, you'll see it's automatically using the formula to inflate up that 4% for the number of years, because those are all in current year prices. You can make it look better for the examiner by reducing the number of decimal points. Now we're ready to do the fixed costs. The fixed costs are inflated up at 3%. Now fixed costs, as you can see, do not change. They're 50 all the way along. So we can do this in a different way. Remember, the first inflation will be at the first year, so we times that by 1.03. We can now just reference in that figure and times it again by 1.03, because the 50 is consistent across all 4 years. So you can use this technique now, copy that across, and you'll automatically see that you've inflated up year 4 times. 1, 2, 3, 4. So that is now correct. Again, good to put that into less decimal places so it's easy to see. We're now ready to calculate our operating cash flow, which will be the inflated minus the fixed. Okay, do not pick up the total contribution again, because that'll be double counting. Now the tax is 1 year in arrears. Let's just check what our tax rate is. It's 20%, so you might want to put that in. And remember, it's 1 year in arrears, so you go reference the first year and pop it into year 2 times by minus 20%. Copy that across all the way to year 5, because remember, we're doing it for tax. The investment goes in year 0. Just check what the investment is. It's 330 million. I pop that up there just to remind myself that it's all in millions. There's no scrap value going in at year 4. Now we're ready to do the tax benefits. Now there's no need to do a working, because remember, they're 25% straight line tax allowable depreciation. And as it's 4 years, 25% would equate to 4 years. There's no scrap value to do a balancing allowance. We simply take the minus 330. Now we don't want it to minus because it's going to become a positive, so we put a minus in front of it, and we times that by 0.25, and we then times that again by the tax rate of 0.2. You can equally do that in percentages as well. It's going to be the same for each year, so we just need to copy that across by referencing the previous year. Now, hopefully everybody's now seen my mistake. Can everybody see my mistake? I've not put it in the same tax year. Let's just move those across. That automatically corrects my mistake. Always good to sit back and think, why is that not level? Oh, I've made a mistake. It should be in year 2, 3, 4, and 5. We're now ready to total down all our cash flows. So sum, make sure you pick up the right sum from the operating cash downwards. And we can then copy that across to the final year. And then we get our cash flows. I'm now going to make that look better for the examiner. So these are now our cash flows that we now need to calculate the net present value on. I'm going to use the net present value function. And so remember, the net present value function works from year 1 onwards, and then you have to take off the year 0 investment. So the function is going to be net present value, put in the rate, which is 10%, comma, highlight the cash flows, and it should give you straight away the answer for the present value of the cash flows from years 1 to 5. We now find the net present value by taking that figure and adding on that minus. Now, if it wasn't a minus, you'd have to take it off. So just really be understanding of what you're doing. And so the net present value, we're now going to highlight for the examiner as being my answer. Going to put it to 2 decimal places, and then just confirm that that is in millions. So now I'm just going to show you how the marks were allocated. You get 1 mark for the inflated cost, half a mark for the inflated fixed cost, half a mark each for both the timing and the calculation of the tax, and that is a known figure rule mark. You get the investment, half a mark, the tax benefits get 1 mark, and then the final mark goes for putting together the net present value function, whichever way you did it. You could have done it by doing the discount tables. The next thing to complete is the internal rate of return. I'm going to use the IRR function because this is the easiest way of doing it. Whichever way you do it, whether you use linear interpolation or the IRR function, you will still get the same number of marks. So with the IRR function, all you have to do is simply remember to take the cash flows prior to discounting, and you take all of those cash flows. You then put a comma in and then you make a guess. So I always guess 10%, 0.1, close the brackets, and then you get the IRR. I'm going to make it to 2 decimal places so I can see it easily. So it's 11.48. That will get you 2 marks. It doesn't matter if you don't use linear interpolation. You're just being quick and efficient by using the IRR function. By the way, you'll also get a different figure if you use linear interpolation due to roundings and accuracy. So now on to the payback period. I've laid out what we need to do here with the years, cash flows and the cumulative. You simply use the cash flows again from your net present value calculation. So you take the total cash flows, copy them across. So then we do the cumulative. So first of all, year 0 would just be year 0. Then year 1 would be year 0 plus the cash flows for year 1. And we can now copy that across to the end. And so if we reduce again down the decimal places, it's easier to see that the cash flow becomes positive at this point. So it's going to be 3 years, and then we need to calculate exactly the part of the year that it is. So it's going to be 3 years, the cash flow we need, get rid of the minus, over the cash flow coming in year 4. And as a decimal, that is 0.17. So the answer is going to be 3.17 years. Make sure you highlight it so the examiner knows that's your answer. We're now ready to do ROCE, and I've laid out the calculation. You need to find out the average cash flows, take depreciation off those average cash flows to get to average profits. And it's based on the average investment, so you need to take that investment and divide it by 2 because there's no scrap value. So the average cash flows, again, use the numbers that you've got by referencing in. So it'll be the sum of the cash flows before tax, remember, and then divide by 4 to get the average, because it's for 4 years. Because ROCE is profit before interest and tax, so we need to take those cash flows before tax. Depreciation per annum is going to be the 330 investment divided by 4. The average profit is therefore going to be 1 minus the depreciation. And then the average investment is going to be 330 divided by 2 because there's no scrap value. ROCE is now going to be simply average profits divided by average investment. And let's show it as a percentage to 2 decimal places. 22.31. Highlight it so the examiner knows that's your answer. So now I'm going to put the marks on the payback period and the ROCE. So the cumulative cash flows calculation gets half a mark, and then pulling together the payback period would get half a mark. So that's your 1 mark for payback period. Then we have ROCE, the average profits calculation, whatever way you do it, will get 1 mark overall. And then the average investment is half a mark, and then putting together ROCE is a further half mark. Remember, the marks for ROCE, payback and IRR are all own figure rule marks because they stem from your net present value working. Now we come to part B, which is for 10 marks and is the written part of this question. It says discuss the suitability of the techniques used in A for determining whether to undertake an investment and advise whether Nunda Stores' proposed investment is financially acceptable. So there's 10 marks going. So you need to split those 10 marks between those 4 techniques and then the advice. And I've done that for you there. It's 2 marks each. That will be the best way of maximising your marks. Spending too much time on one particular investment appraisal technique will limit your marks. So you need to say one thing about suitability in a full sentence clearly explained. And then also talk about the target and whether it's suitable, and then provide advice finally. So here we look at the net present value. What I've written here to get 2 marks is a full sentence explaining net present value as an absolute measure using cash flows rather than subjective profits, takes into account the time value of money. It is the superior technique as it gives an indication of increase in shareholders' wealth. The next mark will come from applying it to the scenario. Here the cost of capital used is 10% and the net present value is 12.4, which shows shareholders are receiving at least a return of 10% plus an additional 12.4 million. So that's where your 2 marks are coming. And you need to do that for each of the techniques. So I've now completed the remaining 3 techniques. I've put 1 sentence explaining the suitability and then 1 sentence talking about whether it should be acceptable or not compared to targets for IRR, payback and ROCE. And then I've done the advice at the bottom, again for 2 marks, putting my information together, saying that the investment is acceptable using 2 of the 4 methods. It fails on the payback test and is 3% under the ROCE target. However, the director should choose to go ahead with the investment on the basis that it has a positive net present value. Hopefully you can pause and see how I have allocated my time to getting 2 marks each on each of those techniques, with a final 2 marks for the advice. I hope that has been very clear for you to follow all of that so that you can be successful in this type of question in your exam.